Welcome back, you legends. I'm Dr. Cal. Let's get right into this video. On Friday, the market closed flat in all three major indices for the day, but on the week we saw some really nice gains, splitting the stock market map right in the middle. We can clearly see tech outperforming the rest of the market, with Tesla, Amazon, Google, Facebook, Apple, Microsoft, and the semiconductor index, as well as software and biotech doing really well in the past week. And all of that really has to do with this. The 10-year yield. The 10-year yield has now been steadily declining, going all the way back to the middle of June. We've seen the 10-year yield flag and decline, flag and decline. We're squarely in negative momentum on the MACD, and the trend overall remains bearish for the 10-year yield. This precipitous decline is what was responsible for the small rally that we've seen in the tech sector. It's possible that yields have topped right here because we've made a higher high on the daily chart, but then again we made a lower high on the MACD, and it was clear that the momentum was slowing down as we made this last high. We are now sitting at the bottom edge of the Bollinger Band and well below the 9, 20 and 50-day moving averages. We saw this little bounce right here, and it's possible to see it touch the 20-day moving average right here before continuing the decline. It'll probably depend on the CPI report that's coming out this week, and if it shows signs of inflation topping, we will probably see a continuation of the rollover in bond yields, because really the driving force behind this huge spike in the 10-year yield was inflation fears. So if inflation starts to top, yields will continue to go down, and that will help tech stocks move up again, because tech and long-term bonds tend to move together. So when yield spikes up, bond prices collapse, and when bond prices collapse, they take down with them valuations on tech stocks and growth stocks. And that was really the reason that we saw this massive sell-off in the NASDAQ. Now, on the other hand, we're seeing a couple of positive developments on the charts. We're now seeing a double bottom on the daily chart with positive divergence on the MACD with a higher low right here. Even though the market has put in a lower low, we're seeing a higher low on the momentum, and momentum continues to go to the upside. We still have some room to rally here in this downward channel. We could see a test of the upper boundary of the channel right here, and that would be a test of the $310 level on the NASDAQ, on the QQQs, and we're likely to see a fill of this gap potentially as soon as this week. Now I have this red line right here marking a very significant pivot point in the stock market, and in fact I do not expect the NASDAQ to go beyond this level right here. Even though we're seeing some bullish developments in the daily chart, guys, I still remain very bearish on the market. I do not believe that this is the low. It's just one low of many that we will see, and I still do in fact expect significant declines to come for the NASDAQ and the S&P 500. In fact, if we look at this pitch fan channel that I've drawn up, I expect the NASDAQ to hit this level right here by the end of the year, and perhaps even undershoot it to go all the way down to the $210 level, and that would mark the 50% Fibonacci line. Now these Fibonacci levels, guys, represent one of the longest, if not the longest, expansion in the economy and the stock market that we have ever seen, and it goes all the way back to 2009 after the great financial crisis. The 0 line is at the bottom and the 1 line is at the very top, and in fact a pullback to the 50% Fibonacci level would reflect a decline of just under 50% on the NASDAQ from the top that we've seen in November, and a 50% drop in the NASDAQ is actually quite typical of recessions and bear markets. So it's absolutely not out of the ordinary to see the NASDAQ decline by this much in a recession. In addition to that, guys, if we take a look at the Fibonacci levels, with the 0 line starting right here at the pandemic lows, we see a convergence of a few Fibonacci levels, one of which is right here, the 0.618 on the shorter time frame and the 0.382 on the longer time frame. And when you see convergence of Fibonacci lines like this, guys, the market tends to want to fulfill these convergences, guys. In addition to that, guys, we also see the shorter term Fibonacci level of 0.786 also coming in really close to the longer term Fibonacci level of 50%, which again makes this a level of interest right here, guys. So it's possible to see the NASDAQ hit this level right here in August or in September and move down to this level right here, perhaps closer to February or March of next year. Now let's take a look at the daily chart for the S&P 500. Again, we have a double bottom right here with the lower low on the daily chart and a higher low on the MACD. It's a very subtle divergence, guys. This is indeed a higher low on the MACD. And I think the S&P 500 chart tends to be a little bit easier to read. And we do have this really clean resistance line that goes all the way back to the end of March, beginning of April. And every single time we've touched this line, we've seen the market sell off. So I do expect to see the market attempt to fill this gap right here at the $400 level, perhaps overshoot this line and then come back in. And in fact, I will be eyeing this level really closely for a short position. Now on the monthly chart for the S&P 500, we can also see a couple of really interesting levels here, guys. A run to the $400 level would take us about halfway through this massive bearish engulfing candle, and that's actually typical of bounces in a bear market. Following that, I expect both August and September to be really weak months, October as well possibly. And if we zoom out really far here, guys, I've actually marked out this level right here as the potential market bottom, and there are a few reasons why I've chosen this spot and this level and this time period right here. Number one, because we have this 0.618 Fibonacci line right here, and again guys, these Fibonacci levels are based on the 2009 market low right here and the January 2022 high that we've made right here. Now this level also happens to coincide with the 2020 pandemic low here, guys. In addition to that, guys, if we simply extend this downward channel right here, it will eventually take us all the way down to the 2025 level on the S&P 500 and to October of next year 2023, and as soon as June of next year, guys, if we follow this 2 standard deviation line, and as soon as March if we follow this 3 standard deviation line. And what tends to happen during bear markets and recessions, guys, is that we tend to follow a simple downward channel like this one, and then really big news drops like a bank collapsing or some economy in the Eurozone collapsing or something like that, like something big, a financial crisis in China or anything really like that. And what tends to happen following big news like that is for the market to drop 1 standard deviation outside of its downward channel. And I'll give you an example of this happening right here in 2008. We had the market trading within this beautiful downward channel, and then we saw the bottom fall off the market right here at the depths of the recession when Lehman Brothers collapsed. And you can clearly see how far we've dropped. In a matter of 2 weeks, guys, the market immediately collapsed by the length of the entire channel. Now, this is the length of the channel that the market was trading within, and if we take that and we move it right here, we can see that the market fell by the entire length of the channel, which represents a 2 standard deviation move. If we add another standard deviation right here, we can see that the market actually formed the bottom at the very edge of the 3 standard deviation channel right here. So this line is 2 standard deviations below the main channel, and this line is 3 standard deviations below this channel. Now, if we apply a similar concept to what we're seeing today, it would actually be fairly easy to imagine that the market can drop precipitously and very quickly to one of these Fibonacci lines right here. And in fact, that could happen as early as August or September, and we can see a drop all the way to the 320 level. And then again, we could see another drop right here in March. Now let's quickly take a look at the VIX, and the VIX actually made a very decisive and very key move to the downside right here, breaking below the support line that we've previously seen the VIX respect, going all the way back into April. And this development is actually fairly bullish for the market in the shorter term, but I would argue very bearish longer term. So in fact, I will be looking at these levels right here to enter a short position on the market, and it would be an absolutely perfect time if the market hits the $400 level on the S&P 500 and we end up somewhere around here. That would be a perfect spot to short the market, because this level here, guys, is a perfect launching pad for the volatility to spike up and for the market to see very, very significant declines like we've seen all throughout the first 6 months of this year. Now let's jump into Nvidia, and we're seeing some nice moves on Nvidia here, guys. We dropped right into the buy zone that I have right here in the dark red, and we're moving closer to the middle of the channel. Now my personal hope is that for Nvidia to close this gap right here at the $180 level, and we could actually see Nvidia do that fairly quickly once we see a break of this resistance line right here that goes back to April. Typically in the market, when we see a break of an important resistance line like that, guys, a full measured move would look something like this. And look at that, it would take us right into this gap fill level right here. And it's really beautiful when you see the market play out within these key technical levels. It makes it a much easier market to trade, and it makes your trades much more predictable. So it's just one concept to have in your repertoire. And when we have a multitude of technical indicators really pointing towards one specific price target, that tends to be a really powerful technical signal. Now let's take a look at AMD. Same thing here, guys. AMD has formed a beautiful double bottom right here with positive divergence on the MACD. And I do expect to see AMD at least go back to this level right here at $85, which was a previous level of support right here and now has been acting as resistance. And what I would really like to see is for AMD to fill this gap right here at the $95 level, perhaps overshoot it a little bit and go to $100, because that's a much nicer rounded number, and we know how psychology plays an important role in the market. This level also happens to sit at the upper boundary of our channel right here, and we've been trading beautifully inside of this channel now for several months, going all the way back to the end of 2021. So I'm hoping to see AMD make a touch of this edge right here, somewhere around here, and that might end up being a good spot to go short again. But personally, I would probably go short on the S&P 500 more than any of these really semiconductor stocks, because we've seen very significant declines in these stocks, and we're now sitting at the bottom edge of a really long-term channel here, guys, that goes back years and years and years. So in fact, I would suspect that a lot of hedge funds and asset allocators will be looking at stocks like this at these levels right here for both AMD and Nvidia, in fact, to accumulate shares right here. So I'm really interested to see what happens with both AMD and Nvidia when the market continues to sell off. Are we going to hold this channel right here, or maybe trade below the channel for quite a while before going back into the channel closer to the middle of next year? Now let's jump into Tesla, and I have some good news for you guys. We have now cleared this high right here. So this is our first high on Tesla for a little while now, guys. We still have this positive momentum on the MACD. And now we have the official news from Elon Musk that he is actually canceling the Twitter deal. And that's very bullish for Tesla. It looks like that Tesla has been coiling for quite a while now, waiting for that news to drop before attempting to fill this gap right here. And again, if we see a bit of a crazy rally here, guys, we could see Tesla test this resistance line again at around the $1,000 level. Now let's take a look at AMC. AMC still looks okay. We're still in positive momentum on the MACD. We've made a higher high here, again for the first time in a little while. And I'm still looking at this level right here, guys, at the 200-day moving average. It also happens to be a significant level here, where it was support in the past and has acted as resistance later on. So I could see AMC attempt a rally to $20 all the way to $23. Again, it all depends on what happens in the next couple of weeks. Now let's take a look at GameStop. Momentum is still negative on GameStop. We're seeing this topping pattern in the momentum. We've seen a similar topping pattern right here, and then we saw a significant sell-off. We're also seeing somewhat of a head and shoulders pattern where we have a head right here and a couple of shoulders right here. Same thing on the MACD, head right here and a couple of shoulders. And this tends to be a very bearish signal, guys. So I do like AMC a lot more than GameStop right now. Now let's jump into the seasonality chart. And again, we do tend to have a nice rally right around the beginning of July, going into the middle of the month. But I've explained in previous videos why I do not expect this second leg to materialize. In fact, I expect us to top right around here in the middle of July, perhaps a little bit later, and then just continue to sell off, primarily because we have a lot of earnings coming in. And if these earnings disappoint, and there's a really high likelihood that they will, because the earnings estimates on the S&P 500 are still unrealistically high, so it's really easy to miss earnings this earnings season. And we've seen what happens when companies miss on earnings. We've seen Netflix collapse, we've seen Peloton collapse, we've seen Facebook collapse. So earnings do matter, and I do expect earnings to come below expectations. And more importantly, I do expect companies to have miserable forecasts for Q3, and that's going to be even more important than the earnings for Q2. Why? Because we've seen this significant weakness in the economy. This is the GDP Now model from the Atlanta Fed, and this model works on forecasting the economy. They've been consistently revising GDP down for the second quarter, and it's now sitting between -1% and -2%. And we've already had a negative GDP print for the first quarter. A second negative reading for Q2, guys, would put us officially in a recession. And I absolutely do not believe that a recession this early has been actually priced into the market. Now, going into next week, we have a few really important earnings coming in. We have Delta reporting on Wednesday. We also have a lot of banks reporting this week. We have JP Morgan, Morgan Stanley, we have Wells Fargo, and Citi. We also have TSMC reporting on Thursday. And for those of you who don't know TSMC, guys, TSMC is the largest semiconductor manufacturer in the world. Companies like Apple, Nvidia, Microsoft, AMD, they all make their chips at TSMC. So TSMC's forecast for the third quarter and its earnings report for the second quarter are going to be absolutely crucial and will give us really valuable information into how hard of a hard landing we are going to see in the economy due to the Fed hiking rates. Next week, guys, we also have the 3-year expectations for inflation coming in. We have the CPI, the inflation report, coming in on Wednesday, the producer price index on Thursday, and we also have the consumer sentiment index coming in on Friday. So a lot of really key economic numbers are coming out next week. So I do expect some volatility here, but hopefully we see some signs of inflation topping, and we are seeing some signs of inflation topping, at least in the PCE measure of inflation. But if we do see some signs of inflation topping on the CPI, that would be really good news for tech stocks. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.